Guys, yesterday the Fed announced a pause on hiking interest rates. Is this really just a pause and they will continue to raise interest rates in the future if inflation remains hot? Or is this the end of the rising of interest rates and that they will most likely start to cut from here on out? Also, what does this mean for your cash that's maybe invested in treasuries or CDs or money markets? The strategy for investing while interest rates are going up is to keep your investments in as short as term as possible so that as the rates rise, you keep reinvesting at higher and higher interest rates. Now that that may no longer be the case, what strategy should you have for a pause or a potential lowering of interest rates in the near future? So let's take a look at that. So first, is this really just a pause and the next step is lower interest rates, or is this a pause and see what happens with inflation where they may have to continue to raise interest rates? So the last time they raised rates on May 3rd, Powell also had to add some dovish comments to kind of balance out the good with the bad. And this time they gave you good, but they add some bad. In other words, we're still not saying we're lowering interest rates, we could still raise. So don't go out there and just buying everything hand over fist in the stock market. That's what they're trying to avoid. So if you look at the implied Fed funds target rate, you can see what the 2023-2024 expectations are of where Fed funds rates will be. So looking at the dot projection, each dot represents a FOMC member and where they think rates are going to be at this period in time. And these rates are from the meeting date of March 22nd, 2023. And this red line is the median value of all of their projections. So in other words, at the beginning of 2023, they were expecting a little bit over 5% for the Fed funds rate. And they're expecting by the end of 2023 for it to be about 4.25%. And going into 2025, they're expecting it to be about 3.1% or so, and longer term, around 2.5%. But the Fed funds futures are showing that it agreed with their sentiment here in the beginning of 2023 and was expecting an even lower rate at the end of 2023. But now it's changed to that it's expecting actually higher rates than what their median expectation is for 2025 of about 3.8 or so. So if you compare FOMC members' dot projections for the meeting date of March 22nd, 2023, that's the gray line here. But now the new projections for the June 14th meeting is actually higher, and that goes along the whole length of the curve out past 2025. And so what that means is they're expecting that there could be 2 more rate hikes before the end of the year, a 70% chance of a rate hike in July, and a 95% chance of a rate hike in September, with no hikes in December and January right now. So this chart shows the odds spiked for September over here up to a quarter point, July up to 0.173, so that's like a 70% chance. And December and January spiked from being negative to about being flat or a little bit up actually for December to 0.137. So why is the market thinking there will be 2 more interest rate hikes before the end of the year when we had a CPI that's going down in the last report? Well, part of it might be because retail sales unexpectedly surge in May, led by autos and building materials. So the green is adjusted retail and food services sales. Seasonally adjusted total monthly change, percentage change is 0.3% month to month, and 1.6%, the blue line, yearly change, percentage change. So gas stations and miscellaneous store retailers saw sales slow as building materials and motor vehicle sales soared. And these are shown as percents and based on data from the Advanced Monthly Retail Trade Survey. So these are preliminary numbers in April, and this is how much higher they actually came in. So in other words, they said, what's May going to be? They projected in April, but these numbers came out 1.4% higher than they were expecting. That's for motor vehicle and parts dealers. Building materials 2.2%, gasoline stations minus 2.6%, and miscellaneous store retailers minus 1%. So it seems like this really is a pause right now. You have the CPI going lower in the direction that they want, but a lot of it could be because of the price of oil. With OPEC saying that Saudi Arabia is going to cut 1 million barrels production per day, and the price spiked up for a little bit, but then came back down. It shows weakness in the price of oil. And of course, that helps with lowering inflation. But we're not out of the woods yet. And you have retail sales up, car sales and construction and housing is still going strong. So they could just be waiting for more data to see if they stop for good and start cutting rates, or they still need to increase interest rates a little more because of inflation being sticky. So what does that mean if you're investing in short-term money markets or CDs or treasuries? Should you start to lock in some longer-term rates in case interest rates will now be going down after this pause? Or should you stay a little flexible in case they still have to raise interest rates? So on the one hand, if you thought interest rates were going to keep going up, you would stay very, very short. If you thought that this is the top and they are going down significantly from here, you would lock in a long-term interest rate on a treasury or a CD. But since it's still unclear, maybe you want to move up the term for your CDs or treasuries up a little bit instead of under a year to maybe 1, 2, 3 years or something along those lines. So let's see what the rates are that you could lock in right now and what looks like the best deal right now in the market. So here on Fidelity, we're going to look at treasuries, CDs, and compare them to corporate AAA bonds. And so AAA corporate bonds really do not compete with treasuries and CDs going all the way out to 5 years, basically, right? You got 4.04 for a 5-year versus 3.98 for treasuries versus 5.25 for a CD. Only up to 10 years do the corporates start to pay more than CDs even. Of course, there's default risk in corporate bonds where there is none in US treasuries. And somebody asked me, which is safer, CDs or treasuries, or are they basically the same? And I would say that the risk is basically the same. Now, CDs have FDIC insurance, which is a fund funded by the banks. But in bad situations, when that runs out of money, the ultimate backstop is the US government, same as with treasuries as well. So basically, if one of these defaults, the other one is probably going to default as well. So they're pretty much the same thing, I would say. The big difference in them is that the CDs are non-negotiable. You can't resell them after you buy them like you can with treasuries. Now, there are some secondary markets, but it's very illiquid and stuff, and you're probably going to lose some money, whereas the treasuries are very easy to buy and sell anytime you want to. And if you buy, say, a 2-year treasury and interest rates go down, you will gain some appreciation in your principal on that if you sell it. So that's the difference between treasuries and CDs. Now let's compare what's the best deal. And of course, this is not investment advice because everybody has a different situation. Some people may need their money in 9 months, and so they put it in this. Some people want to have very low risk and just for the next 10 years know that they're getting 5.25% and put it in this. Some people want to just keep it very short term because they want to get back into the stock market. So you have to know what your situation is and invest accordingly. Now, going up to 1 year, CDs and treasuries are yielding very similar rates, but after 1 year is when there's a big difference, right? So if you're thinking of locking in 2-year rates because you think this is kind of the peak and you want to lock it in for 2 years because that's when you need your money, well, look at the difference between CDs and treasuries, right? That's what, 64 basis points, 0.6% difference? That's a lot. Going out to 3 years, it's almost a full 1 percentage point difference between CDs and Treasuries. And going out 5 years, it's 1.25%. And going out 10 years is 1.5 percentage point difference. So if you're 65 or 70 years old and want to lock in 10 years with very low risk because you don't want to invest in the stock market or you're worried, and you have $1 million, this is the difference between getting $52,000 a year and $37,500 a year. That's a huge difference per year. One thing to mention, though, is that anything past 1 year in Treasuries, you're getting a semi-annual coupon. So if you buy the 2-year, every 6 months you get a coupon. With CDs, you do not get that. So if you need cash flow every year, twice a year, CDs may not be the best idea for you, or you're going to have to ladder them and maybe get a 1 year, a 2 year, a 3 year so that you're getting some cash every year and then you reinvest it. But of course, you have the reinvestment risk, because if you buy this 1 year and the 2 year and a 3 year, at the end of 1 year, if interest rates are now dropping down to 4.5% for the new 1 year CDs, well, now you're reinvesting at a lower rate. Whereas if you buy these Treasuries, you're locked in for that term and you get the semi-annual payments. So there's a lot to consider when you're thinking of the ways to invest your cash, or even if you should stay in cash. And I really wouldn't advocate staying in bonds for really long periods of time, because we see that stocks always outperform bonds over a long period. So this is kind of just a transition till we figure out if interest rates have peaked or not, or if they're going higher, and what effect that's going to have on the economy and the stock market. But like they say, the stock market climbs a wall of worry, and already you see that investors are thinking 6 months or a year ahead, because a lot of stocks are already ticking up in the stock market, and it's no longer just the top 5 AI stock names that are leading the market higher. Now small caps are starting to wake up as well. So you have to consider, should I move some of my money out of interest-bearing things and into the stock market at this point? Or is this kind of like a bear trap and we go lower from here in the stock market after we hit a recession? Or I don't know the answer to that. And as always, this is not investment advice. You have to make your own decisions with your own money. Hope you like this one. Thanks for watching, guys.